Hey guys, welcome to my channel. This video we're going to talk about these topics. What is general purpose financial reporting? In general purpose financial reporting, we produce financial statements that can be used by any economic decision maker. Like when we say economic decision maker, it might include the business owner, the supplier, the customer, the lender or creditor, and the government. General purpose financial reporting. The financial statements are composed of the statement of financial position, statement of comprehensive income, statement of cash flows, statement of changes in equity, and the required disclosures. What is specific purpose financial reporting? In specific purpose financial reporting, we produce financial statements that can be used for only a specific purpose, such as taxation, cash basis, and government uses. In taxation purposes, the financial statements are prepared only to assist the accountant or accounting professional compute for the income tax due or any other tax amount. In cash basis purposes, the accountant either reports cash transactions or converts the accrual basis financial statements to a cash basis financial statements. In government uses, the financial statements may be prepared only to address a specific requirement of a government. We compare now the accrual basis and cash basis. In accrual basis, we record all the transactions even when cash is not involved. For example, in accounts receivable or in recording a sales transaction wherein the customer is not required to pay immediately, we record that transaction by debiting accounts receivable and credit sales or service revenue. In cash basis, we record transactions only when cash is not involved. So if in sales transactions, if the customers have not yet paid, then we do not record that transaction. We only record the transaction only when the customer already pays or have already paid. Qualitative characteristics of useful financial information. For our financial statements, to possess fundamental qualitative characteristics, the financial statements must have relevance, materiality, and faithful representation. Our financial statements can have relevance if it is able to influence the decision of the user. Materiality, it means that we only record material amounts or significant amounts. The materiality depends on the business or the size of the business. Materiality is normally larger for large businesses compared to small businesses. The financial statements must have faithful representation characteristics. So the financial statements have faithful representation if it is complete, neutral, and free from error. When we say complete, it means that all transactions are recorded. All recordable transactions. When we say neutral, it's free from bias or undue influence from anyone. Then free from error. The financial statements must be free from error, or the accountants must strive to produce financial statements that are free from error. Another qualitative characteristic is the enhancing qualitative characteristic. Our financial statement should have the comparability, verifiability, timeliness, and understandability. Our financial statement has comparability if we can compare it to other periods, to other accounting periods, or to other industries or businesses. Verifiability, it means that we can verify the amounts reported in the financial statements. For example, in accounts receivable, we can verify the accounts receivable by asking the customers. Timeliness means that our financial statements should be prepared on time. For example, for the accounting period of 2019, the financial statement should be prepared before the deadline of submission of financial statements, which is normally around the first quarter of the following year, or the year 2020 if it is 2019. Then understandability. The financial statements must possess understandability. It means that the financial statements are clear, produce clear information. So it means that the financial statements must have disclosures, must have complete disclosures about the necessary information of the accounting information. The financial statements, so we have objective and scope. So the financial statements objective is to produce financial information that is useful for the economic decision makers. Scope refers to the composition of financial statements, which is the balance sheet, income statement, cash flow statements, and the equity statement. Reporting period, so it refers to our accounting period, whether fiscal period or calendar period. Calendar period is a 12-year period. It starts from January to December. And fiscal period starts with any month and ending with the same month of the next year. Going concern assumption, it means that the financial statements are prepared on a going concern basis. It means that going concern means that the company or business is or will be continuing its operations on a foreseeable future. So it means that the company is has no chance of shutting down or discontinuing its business. Reporting entity, the financial statements must be based on the transactions of the entity or the business. Consolidated and unconsolidated financial statements. So this refers to the parent and subsidiary relationships. This will be discussed on the separate subject. Elements of financial statements. Under the balance sheet, we have asset, liability, capital or equity. We have income and expenses under the income statement or statement of comprehensive income. These have definitions. To Let's proceed with recognition and the recognition. In recognition, it means we are recognizing, we are placing a transaction, we are putting a position for the transaction in the financial statements or the accounting records. For example, the asset. We only recognize the accounting element if it meets the definition. If it meets its definition. For example, the asset, it must meet the definition before we recognize it in the accounting records and in the financial statement. When we say the recognition, it means that we are already removing the accounting elements or that account from our books, from our accounting books or the financial statement. That's all. Thank you for listening.